Now we're going to start on the daily chart. We're going to do a top-down analysis on this particular pair. And what I like to do right off the bat when I open a chart for the first time is we'll start on the weekly chart actually. And we'll look at what is the trend that we're in. So what we can see when we're looking at the overall trend that we see on pound Japanese yen, it's a little bit confusing if I'm honest, because what we can see is if we just kind of keep zooming out a bit, we broke this low here, which means our low or trading range that we'd be trading in is more so within this range, which is a massive range on the weekly chart. If we go to the monthly chart, we can just see if that gives us any more clarity. And what we can see is the trading range that we're actually trading in is this and this. So what we can see is from the higher time frame perspective, we're in a downtrend. There's really no way we can argue that. And what we're going to do is we're going to look at more of the substructure, because we can all agree it's going to take a while for price to come back up to here or come to this point here. But we do know the higher time frame trend is bearish, but we can capitalize on more intraday or shorter term setups, shorter term being a few days rather than a few weeks in this case. And that's what we ultimately would like to do, or that's how I personally like to trade. So if we're looking at the weekly structure, we can see that we are making a series of higher highs and higher lows. We can see that quite clearly. So when we're looking at that, and we can see that the more substructure here on pound Japanese yen is bullish. So I'm just going to get rid of those weekly lines and we're going to focus on this bit of structure. What we can see when we look at this bit of structure is that price is moving to the upside. And like I said, we are making higher highs and higher lows. You can see that quite clearly. You know, we have a low, we have a higher low, we have a high, we break that high, create this high, we break this high right here. So it takes a little while to actually break. We more or less generate liquidity here. We create lower lows of the range, but really ultimately what this is this is a higher low, higher high right here. We've broken this high and we've now created a higher high. So with that being said, we can break this down into the daily chart. We're setting up our charts. And what we can see is, again, like I said, we broke this high right here. So the trading range, oops, that went away. So we broke this high, which means the trading range that we were trading in prior to this high being broken was this leg in price. Everything that happened here was more or less just noise until we finally broke structure right here. And for me personally, I use type 2 mapping. And what does that mean? That means that I'm waiting for a break of a high in order to confirm that as a break of structure. I use wicks to count as highs and lows, and I'm actually waiting for a break of structure using a candle body. So if I just quickly draw a candle very quickly here. So here we have a candle, and let's just say price moves down a bit and we're coming back up. If I have another candle right here, just delete that, and price creates a wick like this, I would not consider this a break of structure. I would only consider this a more or less a purge of liquidity. This is more of a sweep of liquidity. I'm only going to consider this an actual true break of structure when I see price do something like this, where it breaks and closes above the point of structure. And what we can see is we have that right here. So now that we've been able to identify the most recent break of structure, price is still making higher highs and higher lows. We can identify the trading range that we're in, which would be this impulsive leg or this leg in price. And what we can see is price creates a high. We sweep the high, we come back down, and then we break the high. And now what we can see, if we are looking at our daily range where price currently is within this example, we can see that we're creating an uptrend. Higher highs and higher lows are being created. We've impulsively broken and closing above this swing high in price, and we're now coming back. So what we want to do is we want to identify an order block. And what is an order block? An order block is, in essence, it's the last bearish candle before a bullish move that breaks structure. more often than not creating imbalance. And basically what it is it's a large order or a series of large orders being placed in the markets at a particular price. And once we get that bit of structure, so this example right here, we have a point of interest that we can look at for price to return back to, because once price break structure, we get this impulsive move. What we can conclude is that a lot of large orders were traded at this price level. And what we're expecting is the orders that were placed here were not completed in full, because for every buyer there needs to be a seller, and for every seller there needs to be a buyer. And if this sheer amount of buying strength is coming into the market, the full size of the order was more than likely not matched, because I'm sure there weren't as many sellers as there were buying, considering the overall size of positions that banks, hedge funds, and major financial institutions can pump into the markets. So what we're waiting for when that happens is for price to return back to that order block, and then we would be looking to take that entry long. Now, of course, we can just put a buy entry on either 2 points of the order block. We can take it at the high of the order block, the bearish order block, or we can take it at the equilibrium point with either entry, we can put our stop loss just below the order block, and we can look to take entry there. There's two different ways to take it, the top or the equilibrium point, and for a sell it would just be in reverse. You'd be taking it at the bottom or the equilibrium point, and it would be the bullish candle before the bearish move that breaks structure. And the reason why some people would choose the equilibrium point over the high would be simply to get a tighter entry with a tighter stop loss, because as we can see, if I just adjust this would be a bigger stop loss in comparison. Now, one thing to note, if you are taking the equilibrium entry, there are many instances where you will not get tagged in. Trade will run without you. So something to keep in mind on whether you want to be involved in slightly more trades with a reduced risk to reward, or be tagged into slightly less trades with higher risk to reward. But now that we have that out of the way, let's look at the price action that we are digging into. So what we can see on the daily chart is exactly what I've described. We've broken this high. We have explosively moved to the upside. We've created imbalance. We can now identify our bearish candle before the up move that breaks structure, and we can mark it as this candle right here. So now that we have a daily order block, what we can do now is, instead of just waiting for price to come down, place our order and take that entry with a 64 pip stop loss, we can actually refine this a little bit further and see if we can get a lower time frame entry somewhere at the more extreme point. And basically we're framing up our trade in a way that we have more higher time frame points of interest and targets with lower time frame executions, and this allows us to have precision-based entries that are able to generate higher returns, and also allows us to risk less capital and achieve higher returns. So what we're going to do now is, I'm just going to delete this. We're going to go down to the 4-hour chart and take a look at the trading range that we're within on the 4-hour chart. So what we can see is what we can see when we're on the 4-hour chart is the daily range that we are in was this entire leg in price. And if we wanted to look at 4-hour structure in isolation, what we can see is we've broken this high right here, and this is what has created an impulsive move to the upside. Price then paused, created this high, and has started to trade back down into the order block. Now, depending on how you view structure, you might view this as a pullback, which would mean once we broke this high, this would be our low, and once price actually broke this low, we would consider price to be in a downtrend. But keep in mind, regardless of how you view market structure, it all comes down to what you're basing your overall trade idea on. And in this case, we're basing our trade on price coming back to this daily point of interest. Also understanding that on the daily chart, we are in an uptrend. So we're looking to continue to ride that momentum to take a trade longer, at least targeting these previous highs. So we'll go back down to the 4-hour chart, and what we want to do is we want to refine our order block. We have our daily order block, but we can take this to a slightly more precise point. So what we can do is we can look for the down close candle before the up move that breaks structure and creates imbalance. Now we have two spots that we can identify. If we go to the very extreme of the move, we can see that we have this bearish candle, and we can draw on our order block just like that. And I will make it blue so it stands out. So we have this order block, we have imbalance that was left right here. So we have all of the criteria that we need for an order block, because we have that bearish candle that creates a large up move that creates imbalance and then breaks structure. But we can also look at this area as a potential order block as well, because we still have a bearish candle that moves to the upside and creates imbalance. Although the imbalance is a little bit further along, we can't help but argue there is imbalance. And what we can actually do from a 4-hour perspective, depending on how you view this candle formation, what you can do is you can leave your order block on this particular bearish candle, or you can actually move it to this candle right here, because this is the candle where we seen the true momentum come into the market. We created that imbalance and we broke that structure. So it's a minor refinement, but it is and can be very powerful. One other way we can refine it is what we can do is move our order block down to this bottom portion, this large wick, so to speak, on this candle. And what this will likely show us on the lower time frame is there is more than likely going to be a lower time frame order block that we can refine this candle to. So for the time being, I will put that just like that. And what I'll do, just so we can look at it in a little bit more clear prices, I'm going to put a line and another line just like that, so we can dig into price action on the lower time frame within that range. So if we're just looking at this as well, we can see, if I go back to the daily chart, one other concept that I wanted to just quickly highlight is the concept of premium versus discount. The concept of premium versus discount is very simple. We run a fib with the 0, the 50%, and the 100%. And basically what you want to do is you have a move in price, an impulsive leg or a trading range. And basically, if you're looking to take a long position, you'd want to take any sort of long within the discount area. You want to buy at discount prices. So we'd be waiting for price to come down to that discount area before looking to go long. Taking entries within the premium point can be possible, but over a longer and larger sample size of data, what you'll more than likely see is price return to the discount area before we actually see a true move. And the inverse can be said about selling as well. We want price to return back to the premium price point before looking for a sell point. And this can help us identify and filter out particular order blocks within larger trading ranges. So if we're looking at the daily chart and we draw on our Fibonacci from our swing low to our swing high of our daily trading range, we can see that the order block that we are looking to enter, this daily order block, is within discounted pricing. So we know that we have an edge in terms of looking for buys at those particular prices. It goes back to the old nuance of buy low and sell high. And institutions are going to be doing nothing different than that. And it really comes down to, in our personal lives, if we're buying something, we want to buy it when it's cheaper. And if we're looking to sell something, we want to sell it when it's at its highest price. That way, when we buy something, we're getting the cheapest value we possibly can. We're not spending more than we need to. And when we're selling it, we want to make as much money as possible. So we sell at higher prices. You wouldn't want to sell something at a low price and buy something at a high price. And the institutions are smart, and they're reusing this concept as well. So now what we can do is we can also apply that concept to our 4-hour range, which would in this case be our daily range as well. And again, like I said, we broke the structural point if we were viewing this as a pullback. So what we could see is that our current range of price would be at this point. We're looking to buy at either of these points. So in theory, if we were waiting for price to come back to a point of interest to look for a sell, that would be the best place to look for that trade. But of course, like I said, I am viewing this entire leg as one impulsive leg in price, because I do not view this as a pullback of market structure. So what we'll do is we'll drop down to the hourly chart, and we'll get rid of this just to clean up the chart. What we can do is we can take this one step further and we can refine both of these order blocks just a little bit further, and then we will play price and see if price taps into either of these blocks, and we can see if we can get an entry. We'll start with the bottom order block, and again, we're looking for the bearish candle before the up move that breaks structure. And what we can see is we have this bearish candle, which is the last bearish candle before the up move that creates the larger impulsive move that breaks structure. And what we can see is the next candle doesn't necessarily create any sort of momentum. It's not really until this candle right here that we start to see the impulsive move to the upside. Now, one thing we can also take note of is that in this case, price has been efficient. We have been able to fill the inefficiency that was left or that was created when just this candle finished printing. So although we don't have imbalance, this order block is still valid. And what we can also do is we can apply the same concept to this order block right here. And what we can see is we have this down move candle, which we can draw on. And again, we can refine to this candle right here, which is the move before the real momentum actually started to trickle into the markets. Now, if you're looking at these points as well, let me just zoom in a little bit more and asking yourselves, well, how come we didn't refine to this candle or this candle, or use this candle or consider this candle? Those are all very valid questions, especially when you start to break down order blocks and the overall refinement. The reason why I choose not to refine any further from this candle to this candle, say, is because once we get to this candle, we're starting to just push our order block quite far. We could use this as a valid order block, and maybe in this case, this one would be a little bit more valid. It's really not increasing the overall order block size by too much, so we can use that, but I would not go any further than this as we're starting to push outside of the overall higher time frame order block that we're framing this trade within. When we're looking at, say, this point or this point, we're really more or less just fixating on opposite ended candles that have not as much validity in price, although we can't argue that there is imbalance here and here, but we need to start to begin to understand that when we see consolidation like this is more or less a lot of orders starting to trade hands. We're seeing a lot of buying and selling, and it's causing price to more or less move sideways. And the reason when we see price moving sideways is because there is that equilibrium in price. There are a lot of buy orders and sell orders being met in price, and it's basically an agreed upon price, and a lot of transactions are trading hands. When we see price rapidly moving away, that means that one side of the market, in this case buys, would be taking over. If we see consolidation, that means that more or less there is an equilibrium in price. People like that price and they're willing to buy and sell within that price. So now that we have that, what we can do is we'll play price forward. What we're looking to do at this point is we're waiting for price to come into these points of interest, and we're going to look for some type of reason for entry. We can also take this one step further. We can go down to the 15-minute chart and we can refine these order blocks just a little bit more, just to give us a slight edge on our entries. And what we can do is with this order block, we can take it to this extreme price, which is the last bearish candle before the up move that breaks structure, and continues moving back to the upside. So we'll just drag that over and we have that. And again, it kind of comes back to the same point that I said, where you can also begin to ask the question of how come we didn't use this candle, this candle, this candle. And the problem is when you start asking that question, especially once you get outside of your point of interest, then you could start asking, well, why didn't we use this candle, this candle, this candle, until we're 200-300 pips to the upside. So something to keep in mind. But the reason why I use this candle over these candles, specifically this candle, is because if we just look at this, we can see that price did create a break of structure. We moved to the upside. We created a little bit of imbalance. We came back down, tapped in, and then moved back to the upside. So this is what we would call a mitigation within the larger order block. Whereas if we see this has yet to be tapped into, we have that imbalance and price begins to trade further to the upside. And what we can do again is we will map out this area. We can see we have a bearish candle. We have this candle right here. And what we can see is price mitigates it in here. So this will be the only time where I would be a little bit more willing to refine my entry to this stage. But what I'm going to do instead, as now I'm kind of diddling in the middle of these two trading ranges or these two order blocks, I'm actually going to get rid of that. I'm going to skip the 15-minute here. We're going to go down to the 5-minute and just see if anything exists within that range. And what I can do as well with the 15-minute one is I can actually refine it down to this candle right here. So I'll just zoom in so you can see that a little bit clearer. You can see that we have the bearish candle before the up move that breaks structure. We can bring it down to this candle, as this is the origin of that move that broke that structure. And what we can also do is look at price action down here. It is relatively messy, but what it provides us with is we could use this candle, but we can see as price taps into it, taps into this order block. So what we can actually do is refine it to this point right here, as this is the last move. And the difference between that 15-minute one and the one that we were just looking at is our order block would have been all the way up here. We've been able to refine it to a little bit smaller level. We're at the base of the hourly and 4-hour order block, so it gives us a little bit more precision. Again, we've done all our refinements. We're looking for price to tap into these zones and give us entry criteria. Now you can set orders on the lower time frame points of interest, say the 15 or 5-minute, and use a risk entry, which would just be that you have a point of interest. You set that order. So you would set a buy limit order with a stop just below, and you're just waiting for price to tap into it and tag you in. Or what we can do is we can look for a confirmation entry, which would mean that we're waiting for price to come into this zone and then show us a break of structure to the upside. And then we have two options within this confirmation on how to take that trade. Our initial entry, which would be the risk entry of the confirmation entry, we would wait for a price to come back. We could put our buy limit here and take the buy here, or we could take more of a safer confirmation within that confirmation, wait for a secondary break of structure. This would confirm that on the lower time frame, we are starting to see bullish order flow, and then we can take a buy position on the newly created point of interest to take that long. So that's the process. There are a couple different ways that you can do that. I personally am a fan of confirmation entries. I like to have that additional confirmation when I'm looking for entries, and when I'm framing up all of these points of interest, I'm not necessarily looking at these as hard and fast areas that I'm definitely going to enter on. Instead, they're points of interest that once price gets to these areas, I am now interested at potentially entering a trade at those price levels if I get the proper price action footprint that I'm looking for. So what we'll do is we'll play price forward just a little bit. We'll go candle by candle and just wait for price to tap in. What we can see is we've tapped into our first area of interest, and what I'm going to do is we're going to go down to the 1-minute time frame.
I just want you to know that I also share trading signals to community for free in the Telegram channel. For example, yesterday, I share the gold signals to community. You see all 3 TP getting profit yesterday, and the whole community getting profit by this trade. You can see every day I share trading signals to community, and most of them get profit. And especially, I do not only share the trading signals, but I also share the markup and the reason why I enter the trade. And by this one, everyone in the community can understand the reason, and by that, everybody can improve their trading skill. And to join community for free, you can click on the description of this video and click this link here, and you will be directed to the community and join for free.
We're going to look at structure, and we're going to see, do we get an entry? So we can see as price came down, we created equal lows. We broke those equal lows. We created this low. We broke that low, which means our range high of that particular trading range would be right here. Let me just make sure that this does not appear on anything above a 5-minute chart, just so it keeps our charts a little bit cleaner. And we'll make that one more thick so we can see it. So what we can see is price has broken structure to the upside. We're starting to get bullish order flow to the upside, which is something that we want to see when we're looking for an entry. So what we can do now is we can look at this particular move. If we want to take the risk entry within inside this confirmation entry, we can see that we have an order block right here. This would be our 1-minute order block, a potential entry for this trade. So what we can do is we can put a buy limit order with our stop. This is where it comes to personal preference. If you have a wick that's just below the order block in question, what you can do is factor in that wick to your stop loss to give it a little bit more room, because more often than not, when you see wicks like that, price will tap into that range a little bit further, because that is a form of liquidity. And one other quick tip or something when you're placing buy trades is when you're placing up a buy trade on this FXCM data feed, you can see I have a 0.5 pip spread, which I think is maybe oddly incorrect on many brokerage firms for pound Japanese yen. But basically what you'd want to do with a buy position is you actually want to trail your order or front run your order by the spread. And basically that allows you a better chance if price just comes in, taps that, and then goes. You've accounted for spread, because if your entry is right there, your spread would actually put you at a slightly bigger disadvantage of getting in, and you'll probably end up missing your trade. So something to keep in mind when you are placing an order. Of course, again, I want to put my stop loss just below that wick, which I will do. And what we can do is we'll just keep playing price forward and see if we get tagged in the trade, if we get stopped out. and basically just see what happens more or less. So we'll just play price forward. What we can see is we've been tagged into this trade. Now, when we're looking at this trade, what I can see as an initial target, and this will also be a area of management for my trade in question, is we see these equal highs. And if I'm looking at the overall trading range that we are in on the 1 minute chart, it's within this impulsive move. And basically, if I just draw those out, I'm waiting for price to break these equal highs as well as the overall trading range. Once it does, I'll move the trade to break even. If price breaks to the downside, I'll be stopped out of the trade, and we will just again wait for price to tap into the lower point of interest or see if we get any sort of strong reaction. At this point, I'm okay and I'm willing to accept that I'm going to take losses. I'm just waiting for my criteria to be met in order to take that trade. So again, my criteria is waiting for a switch in trend. I can take the risk entry at the first point of interest, which would be this spot right here. And as we can see, we've just been tapped in. Again, this from a spread perspective, we may not be tagged in a real live market condition, or we can look to take the confirmation or more safe entry as we've seen higher highs being formed, and then wait to take that entry. So what we'll do is we'll just continue price and see what happens. Let's make the chart a little bit bigger so we can see it a little bit clearly. Gotta love GJ's price action where it is extremely wicky. And what we can see is we're starting to move back to the downside, which is a more than likely case that we're going to get stopped out. One thing you can do if you want to be more aggressive with your stop loss, but it's not something I recommend, but it depends on your risk aversion, is you can look at the substructure, and what we can see is we've come down, basically created a high, we broke that high slightly, created a low, we broke that high, which created this, which allows us to use this low. And then basically if we're just looking at structure, we could use this as a low and then basically just be monitoring this high. Once price broke this high, we could have moved the trade to break even to hedge ourselves, especially knowing that there's a point of interest below. But personally, I would rather wait for this high to be broken, as it gives us a more clear edge in terms of giving the trade room to breathe, because what could have happened right here, and we'll probably see if it does or doesn't happen, is it could come down, get a little bit of drawdown, and then continue to move to the upside, because we'd still be tapping into that point of interest. So different opportunities in terms of how you can take the trade, but just something to take note of. And what we'll see is we've been stopped out of that trade, which is totally fine. And this is the power of looking at the confirmation entry, is if we were not taking the risk entry side of that confirmation, we'd wait for a structure break of this high before we look to enter, which would help us avoid the loss here. So we'd be waiting for price to do this and then look to enter. But it's not a problem that we took the loss there, because we have more points of interest that we can identify, and we'll just wait for that to happen. One other thing you can also do when you're looking at break structure on the 1 minute and trying to find more clear definitive structure to trade off of is wait for a 5 minute break of structure and then look to enter on the 1 minute. So it helps filter out some of the structure that you are looking at. And what we can see is we pop just outside of the zone, and we are starting to give us the same criteria where we're seeing a breakdown of structure to the upside. We can identify a point of interest. But if I look at this bit of price action, we have this bearish candle before the move that breaks structure to the upside. And again, if we go by our refinement, we'd have this candle, but the next candle doesn't really give us momentum. It would be until we get to this point, which is much closer in the range. And because we're outside of the overall zone or point of interest, I'm going to sit on my hands and see if we get a stronger push to the upside that will give me confirmation, or alternatively wait for price to give us a retrace, break that structural high, and then look for an entry as well. Another great way to improve your strike rate and just wait for further confirmation. And what we can see is, although this is a strong and decent impulse, I am not entirely sold on this. And as we can see, we did get a small reaction here, but it wasn't strong enough. We've broken to the downside. The fact that we've come out of the point of interest, the larger, higher time frame point of interest, gives me a little bit of insight that price is probably not going to respect this area, because we have another point of interest down here. So what I'm going to be doing, again, now that price is approaching this point of interest, I'm going to basically wait and see if we get the same sort of price action to enter long. And what we can see is we're now tapping well into this point of interest. We can see that the 5-minute order block didn't give us any sort of insights or any real help, so we can just delete that. It's not a big deal. But again, I wasn't entering directly on it, so I had no problem refining to that point. It was just a matter of using that as a potential point of interest because we can see that we had the imbalance, but price is looking to tap in deeper. There might be a 30-second or lower imbalance that exists that needs to be filled, but regardless of that, it's not overly important at this point. We're just waiting for price to give us the entry criteria that we're looking for. So what we'll do is we'll drop back down to the 1-minute time frame and look at structure and see if we get anything that we are looking for. So if we're looking at the trading range that we are currently trading in, we would be looking at this. So if we're looking for a buy entry, we want to see this high get broken before we even think about doing anything. So let's play price forward. And again, we can see that we've broken this low. We've broken it impulsively. We can move our low to this point and our high to this point. And what we're doing is we're just waiting for a break of the high. If we get a break of the low, we'll more than likely tap out of this range. So more than likely, this won't be something that I will be too interested in taking, but it's something that we can look at if we get the right clues. But more often than not, when you start to see price gravitate outside of the zone and close outside of it, it lowers the probability that the trade's going to work out. What you want to do then is wait for more confirmation. You want to be strict on your entry criteria if it does that. And we've seen that right here where we were more strict on what we were looking for. We were going to take the confirmation within the confirmation and we didn't get that. We saved ourselves a loss and price continued to the downside. So what we'll do is we'll just keep playing price forward. What we can see is we have a substructure break here on the 1 minute, but we're waiting for price to break this overall range high before we look for an entry. We can see we've now broken this high, so we can start to look for an entry. And when we're looking at this bit of price action, what we can see is that we have, in theory, 3 different spots that we can look at for an entry. On the very basic end of things, we can look at the bearish candle at the extreme of the range that has broken structure. We've created imbalance. We can see that this is a clear and strong impulse to the upside. So we can use this as our starting point. And in theory, we can leave it to that candle. There's absolutely nothing wrong with it. You don't have to refine the candles if you don't want to. Again, this comes down to your own personal preference and what you've personally back tested. Play around with refining and not refining and figure out what makes the most sense for your trading plan. But what we can do is we can refine to this candle right here, because if we were to leave it at this candle and refine it to this candle, we can see that yes, we did get some momentum, but then we came back down and then we've broken this substructure high. So we'd be more interested in this point right here. And we can also factor in this area as well. But personally, when I'm looking at the overall move, this is a clear pullback that has the bearish candle before an up move that creates imbalance. We can see that there is a small amount of imbalance and then that move breaks this structural point. So we can look at that as a potential entry. And so what we'll do is we will place a buy limit order on this order block right here. And again, we're going to add a 0.5 pip to our order to factor in the spread that we're being quoted here on FXCM. It's 0.7 now, so we'll just move this up to 0.7 right there. And when it comes to a stop loss, I'm going to want to factor my stop loss at least under this low, but more specifically for me, I'm not really too hard pressed on a 4.5 pip stop loss. I think that's actually pretty solid for pound Japanese yen. This is a pretty volatile pair as it is, so I want to give a little bit of room to breathe. Especially when it comes to risk entries, what I do recommend as well is that you use a slightly wider stop loss on the risk entry than you would as the confirmation entry, because we haven't really confirmed that price is willing to continue to the upside. This could just be a grab of that liquidity and then a push back to the downside. So always something to keep in mind and consider. Again, test it, see what makes sense for you. And what we'll do is we'll just play price forward, see if we get tagged in. And what we can see is, when we just break down this range, we've broken this high and we've now created another high and we've created another high. So if we're looking at the trading range that we're within, we can argue that we are now in a bearish trend because we've broken to the downside. But that being said, we can also say that this is a potential point of interest that we can look to take a long position on. Now, when it comes to this sort of price action, this would be in theory your confirmation entry, because we've created a high, or sorry, this would be a confirmation entry because we've broken this high, we've retraced, and then we've broken the high again. Well, more specifically right here, but it was really this point that is the true break of structure. So we could frame up that this is the point of interest that broke structure. Would be, of course, this bearish candle first, then we would refine it to this candle, and we could look for an entry to go long. But in this circumstance, more often than not, what you're going to find when you have a point of interest that has imbalance like this, price is more than likely going to gravitate to this point. We might get a small reaction and then a dip to the downside. So if you do take this entry, I would recommend being aggressive or more aggressive with that entry. But what you can do is just take that. I would factor in this wick just to the downside. We have a 2.5 pip stop loss. We're in drawdown right now, and we'll just play price on and see if we get stopped out. We did get stopped out, which is fine because it depends on how you want to frame up your risk. When we're looking at these setups, what we can see is we also did have a small amount of imbalance right here. So what we can actually do is look at this point as well as a potential point of interest. Next, I'll remove that. And what we can see is price has just barely tapped into this smaller order block and has started to push off. So what we can see when we're looking at this overall session, I like to risk either 1/4 or 0.5% per trade. More often than not, it's 0.5% per trade. So what we can say is right now I've taken a loss here. So that'd be 0.5% loss here and 0.5% loss here. I still have my order down here, which is on this bottom order block, as this is kind of the last point that I would like to see price return back to. So what we'll do is we'll play price forward and we'll see if we have a successful trade or if we take a loss. It would be pretty good if I take 3 losses in a row without taking a win, but that's just the way it is. What we can see is we've tapped into this order block and we're just waiting for price to either stop me out or continue moving to the upside. Now, if we're looking at an overall trading range, we can look at it in a couple different ways for management purposes. We can see that we've broken this high, we've broken this high. So this high would have created a low right here. We've broken that low. We have a low here, broke that low. So we're more or less trading within this trading range. So we can do one of two things when it comes to management. When price, and when and if price breaks to the upside and breaks this structural high, we can move our trade to break even, or what we can do is wait until price breaks this high to manage the trade. Totally up to you in terms of what makes the most sense, your overall risk tolerance, things like that. But in this case, what I like to do is I'm actually going to wait until this swing high is broken. And the reason for that is just in case price returns back, just in case price breaks this structural point, and I move to break even, say here, creates a point of interest. We could come down, wick through it just slightly, tag me out, and continue to the upside. Again, something to do on your own testing, things like that. Figure out what makes sense to you, but that's personally what I would prefer to do. So what we can do is see if price continues to the upside. So we've gotten that break of structure of this high, and we've now broken this high right here. So what I'm going to do is I'm going to move my trade to break even. So I'll move my stop loss into profit, and I've been able to secure that trade. Now, when we're looking at an overall target and what we would be expecting out of this trade, this is when we can start to go up to the higher time frames and start to look at price action and figure out what makes the most sense in terms of overall targets. So we're starting to see a small reaction. I've probably advanced the candles slightly because I'm navigating to the higher time frames. So we'll count it as cheating, but what we want to do now is look at the overall target. So we're trading within this daily order block. That's the premise of the entire trade that we are looking to take. So it's only natural to look for the previous swing high as a potential point of interest to look for that entry. We can go down to the 4-hour. And what I had said at the beginning of the breakdown is if you viewed this as a low, we would have this strong impulsive move that we are still in a downtrend. So what we can do is we can look at this as a potential point of interest here on the 4-hour chart. Although we haven't broken structure again on the 4-hour definitively, we can't help but see that we have seen a lot of momentum back into that order block. There's some imbalance to be had. So what we can do is just move our target here. What we can do is partial out a majority of our position here and then effectively just aim a little bit higher to see what happens. But I think the initial target that makes sense would be within this refined 4-hour order block. So what we'll do is we'll go back and just go on the lower time frame as well and see on the 15-minute we broke structure, and our high would be right here or right here, depending on how you want to view structure. This is a much cleaner swing in price than this is. This is a little bit of a pullback. Personally, I like this high better. So if I'm looking to partial out, potentially this would be a good spot. But because I'm targeting more of a 4-hour swing, I might want to start thinking about taking partials either more here, and because my overall target's here. So maybe that 15-minute partial looks good here, and then waiting here to close another portion of the position on the hourly chart. And basically what I'm doing is initially I'm using the lower time frames to partial out a small amount to pay myself. And then as price continues to move to the upside, if it does, which we've seen that it does at least get to somewhere around here, we can then move to the higher time frames, the hourly chart, to take partials on a more clear point of structure and then wait for our larger targets to get hit. So what we'll do is we'll go back down to the 5-minute chart, because what we can see on the 5-minute chart now, if we just move this back, one thing that my biggest gripe with TradingView is once you switch time frames, it likes to move your entry tool all over the place, but I digress. So what we can see is we've broken structure to the upside. So what we can also do is we have this order block right here on the 5-minute. So what we can see on the 5-minute is we have this impulsive move down. We've created this low and we have our high here, but we break this low, which means our new high would be right here. We sweep the liquidity of that high, but then now we've actually broken and closed above this 5-minute swing high. And what I'll do just to make it clear is just get rid of those lines, and we can put on the 5-minute structure as well, because I know that some of you don't trade the 1-minute chart, and there's absolutely nothing wrong with that. So I will mark up this. So what we can see is we have broken this low right here. We've now broken the high. And what do we know about that is this is starting to form our entry model, where we have a break of a low, we break that high, we can look for a risk entry, we can wait for that high to be broken, look for that confirmation entry, and then take it long. So if we didn't take the 1-minute trade, or we wanted to scale in, we can also potentially look to do so. Now, one thing I need to do in this case, because I'm going to look to scale in and I have this 1-minute trade already on the cards. So what I'll do is I will frame up my trade just like this, put my stop loss just below this wick. But what I can see is I already have this stop loss inside that order block, and since I have that trade running, that just doesn't make sense to me. So what I could do is I could take some partials, basically take the equivalent of what I risk, so 0.5%, secure that as profit, and move my stop loss either just away, or what I can do is put the stop loss either below this wick on the 1-minute or put it in line with this trade. That way, if this is a loss, it takes me out. I would have already secured the risk, and then this would have been a small loss, so it would have been basically a break-even trade with maybe a little bit of a loss, which is totally fine. What I can also do with this 5-minute trade, if I'd like, which I will do, is I have this 5-minute order block, which we've set our order on, but what we can see is we have this point right here, which we can refine our entry to, and which I will. And again, I'm going to front run my order by the spread. We can see that the spread is about 0.7. It's always going to be moving, so you kind of just have to roll with the punches and sometimes either average it out or pick a number that makes sense based on the trading time frame. I'll put the stop loss in line with the overall block itself. And what we'll do is we'll just play price forward. We're going to just wait and see. Since I have this 5-minute trade up and framed out, we're just going to see if price taps us in. We won't do any management for now, because whether you missed the 1-minute trade and you're looking at the 5-minute trade, or you have the 1-minute trade up and you're looking to scale in on the 5-minute trade, which we've of course refined to the 1-minute chart, we wouldn't necessarily want to manage this trade unless we're going to partial out, which we could. If price returned to this area, we could look to take some partials a little bit more aggressively, knowing we're going to come back down in, because there's nothing wrong with taking trades that do basically something like this. You close out the trade here, you wait for price to return back, and then get back in and just continue that process. You can trade the ebbs and the flows of the markets if you have the level of precision and patience and skill and everything else. So now what we'll do, without rambling on too much, we'll just play price forward, see if we get tagged in, see if I take another loss or not. And what we can see is we have been tagged into this trade. If I had just put my stop loss underneath that 1 minute order block, we probably would have been tagged out by spread, but we kept it nice and safe. So now that we're in this trade, we can manage it in one of two ways. Because we took it on the 1 minute, we refined our entry on the 1 minute. We can look at a 1 minute point of structure to actually look to manage the trade, or we can do what we've done already, and that's look for a point of structure.
I just want you to know that I also share trading signals to community for free in the Telegram channel. For example, yesterday, I share the gold signals to community. You see all 3TP getting profit yesterday, and the whole community getting profit by this trade. You can see every day I share trading signals to community, and most of them get profit. And especially, I do not only share the trading signals, but I also share the markup and the reason why I enter the trade. And by this one, everyone in the community can understand the reason, and by that, everybody can improve their trading skill. And to join community for free, you can click on the description of this video and click this link here, and you will be directed to the community and join for free.
And what we can see is we have this point of structure. This would be the high that I would be looking at being broken to manage the trade, because if we look at this overall range, yes, we do have a pullback here. To me, that's not overly definitive. I like to see a clear pullback before I mark a high or a low. So we can see that this high was never broken. So really at the end of the day, our low would be here. So we broke that low, but that would just mean that our high would be right here now. A very small change on, this high to this high. If we're moving it just from the bullish leg, we'd be here. But because we broke this structural point to the low to tap into this order block, we're now technically switched bearish, but we have the higher time frame trend that we're trying to follow here. We're reading between the lines, but this would be the point, is basically what I'm trying to get at in way too many words. But what we can also do is we can look at the 1 minute as well. And what we can see is we've broken structure to the downside. We have a high here. In theory, we could move our trade to break even here. I'd want to see this clear high being broken before I move to break even. So what I can do is secure our first trade to break even right here, and we'll just wait for price to break that swing high to secure the second trade for break even, because you don't have to manage both trades the same. You can manage your initial trade a little bit less aggressive and you're scaling more aggressive, or vice versa, depending on how you want to do it. So we'll play price forward and see if we get a break of that high, which we do. So now what we can do is we can move this trade to break even. And what I'm going to do, so that I don't have to get annoyed with how I can't manage my trade, is I'm actually going to move my info line to the top. So now I will be able to actually select it. And I'm going to create a copy of that without the risk to reward tool. Thank you very much. So I can move this to break even, which I think is a fantastic idea. But what we can see is, we can see a couple things actually. We can see that price is broken structure, obviously. We can see that we have a potential point of interest right here. We've left imbalance, we've broken that structure. And then we also have a potential point of interest here, although we see fairly efficient pricing. And really, if we refine it, it would be to this point, which we do have imbalance right there. That's something we'll want to be mindful of as we continue on this trade. If we go up to the 15-minute chart, what we can see is we've not yet broken this structural high. Again, if we use this high, we've broken structure, and we can look at this point as a potential entry area. If I draw it on with a rectangle instead of a line, we have this as an order block. We've created imbalance, and we can see if price taps into it or if we just continue pushing higher, which we do. And it's always one of those things where it now comes down to personal preference on how you want to manage, how you want to approach the charts. Do you want to continue to scale in? Because as we can see here on the 1 minute chart, if we're just following market structure, we had this clear point of interest. We've broken structure. We broke it very impulsively, and we basically cleared out all of the liquidity that rests above here. So technically we could have looked to scale in here as well. Obviously I clicked forward on the 15-minute chart, so we did skip a little bit of price action, but the scale in was definitely there. And so what I'm going to do now is I'm just going to keep playing price on, and we're going to now start to manage this trade a little bit more. So we've broken this structure, we've run away from it, we've broken this structure, get rid of that, we don't need. And what we can see is now what makes sense is we can trail underneath this swing low right here. And if we look at the time, we can see that we're in spread hours. So I don't necessarily want to do too much at this point. I do see that that 1 minute point of interest that I pointed out is actually a 5 minute as well. Again, we cleared the liquidity, the equal highs that were resting here. We had this point of interest right here. We've tapped into it and we're starting to run away. Spread hours though, so we'll see what actually happens. Get very choppy price action. Oop. That's interesting. We get a sweep of those lows and taps into more of this point, which is the order block again. So what we can see, if I just draw that on, is we have this 5 minute order block that price tapped into initially, which was during spread hours. So whether or not you would have gotten the fill during that spread was highly debatable, especially on a pair like GJ. But now we can see that this is around 10 p.m. Eastern, which is during the Asian market. So this pair would be fairly active. So that we've tapped back into it and we'll be continuing more than likely to the upside if we are to follow the order flow, which we can see we have. And now that we've seen this mitigation, we can actually move our stop loss just below this wick, or this wick more specifically. And the reason why I'd pick that is because this is the last swing low before this move that's broken structure. We have this new structural low and then price has continued to move to the upside. If I go to the 15 minute, we just see if there is any other potential entries or things that maybe we have missed. We have a potential point of interest still right here. But besides that, everything's pretty efficient. It's all looking pretty clean. If we look to the hourly chart, we can see that we have broken this structural point. We have this more or less move to the upside and then pull back down. But again, more of a key structure would be here. This is where I would look to take a quarter or maybe even half of my position off at this point. You always want to pay yourself. And I think that that's something that's incredibly important that not a lot of traders talk about. A lot of traders just talk about effectively compounding their account until it reaches $1 bazillion. And if you're trying to trade for freedom and for income, things like that, holding the gains in your account forever is never actually going to get you anywhere. So you want to make sure that you are paying yourself at appropriate times. So like I said earlier, this would be a good structural point to basically take some profits. It doesn't have to be a lot. It can be even 10% of your position, 5%. I mean, I would probably do about 25% at least, but you know, it's totally in your favor of how you want to do it. Let's make this line green, as that's where we would likely partial out a small amount. So we'll go back down to the 15 minutes, and basically what I do is I like to initially trail my position using the 1 minute or my entry time frame to move to break even. And then what I'll start to do is move up time frames a little bit as the moves continue to happen. And what that's doing is it's giving price a lot more room to breathe before it continues moving back to the upside, or basically in the direction of the trade that I'm looking to take. And we'll just play price on and see if there are any bits of structure that we can look to manage on or anything that comes up. So we can see that price is just accelerating to the upside. Move down to the 5 minute just to take a look as we're starting to see a pause in market structure. So what I would do now is I want to manage my trade. This spot looks pretty good. As we can see right now, the trading range that we are trading within is more or less here to debatably here, or here if you count that as a mini pullback. But on the 5 minute, I like to see something a little bit cleaner. So that is the cleaner price action leg that I would be looking to trade within. And we can see that we do have a point of interest. So if we were looking for a potential scale in, that might be a good spot, but we'll see if price comes back to that spot. Let's keep playing price forward and see what happens. And what we can see is we've more or less ranged. This is the London session into New York. New York opens just about right here. You can see that we've finally broken these equal highs right here. And now that we've taken that liquidity, that tells me that I'm going to want to manage my trade, because we either are going to keep continuing to the upside to continue this overall trend, or we might start to see a reversal. Well, we are also going to factor in the fact that our 4 hour point of interest, the area that we were looking at taking this, potentially closing the position, is upcoming. So that's also something that we'll keep in mind. So what I'll do is I will move my stop loss to, We'll start at this point right here. Maybe we'll go up to the 15-minute and see if we can get a clear bit of structure, which is that swing low. And that's why clear swing lows make a little bit more sense on the lower time frame charts versus something like this. It's not that clear on the 5-minute. It's definitely not clear on the 15-minute. So we'll just keep playing price forward and see what happens. See that price is starting to dig down a little bit deeper. We'll just drag that line and see if we end up getting tagged out or if price is going to continue moving to the upside. And what we'll do is we'll just move back up to the 15-minute chart. We can see that if we were looking to scale in, although this at this point is trading more in the middle of the range or the extended part of the range, so a scale in maybe doesn't make a whole lot of sense, but we do have this point of interest. The reason it's a point of interest is we see this impulsive move to the upside, we break structure, we take the liquidity, and now we've come back down to it. So we could look to take an entry right here. Although, again, we're very far into the range. We're close to our target, so we wouldn't necessarily want to do that. Hi. So we'll continue price on and we'll see what happens. So price has hit our target. Now, at this point, again, we don't necessarily have to close the position, but a good partial point would be at this point, I would say about 75 to 80% of the position would more than likely be closed for me, and my final target would be the daily swing high. And we'll just continue and see. Price hits the target and we are out of the trade, so we'll just put that here and here. So what we can see if we just look at the two positions that we were able to take, we had a 46.95 R and we had a 41.53 R. We of course partialed out, so we would have taken a quarter of the position off on both here and here. And what you can see is, although that we took two losses along the way, these two wins made up more and really cleaned up all of those losses. They made them not even relevant to how we trade. And that's how easy we can keep our trading. And that's the power of the strategy we have. Yes, we might have a lower strike rate, and that can be daunting for many people, but when we start to frame up our trades this way using higher time frame points of interest and lower time frame entries, we can build some very fantastic trades that even if we take a couple losses prior, it's the one or two positions that we take that hit the target profit that are ultimately going to give us the risk to reward and the return that we are looking for in trading. So I hope this video was helpful in putting together all of the pieces of the puzzle, how I am framing up trades, how I look at trades, how I enter, how I refine, how I filter, how I manage. Again, we used a higher time frame point of interest, this daily order block. We refined it down to 2 points, and then we waited for the lower time frames to tap into those blocks, and we looked for entries using the entry models that I've provided. And what we can see is the first entry did not go in our favor. We took a loss, which was fine. We seen that price came down and broke the zone, so we sat on our hands. Again, when I talked about this one, and a way to avoid the loss there, especially since we had a zone below it, was instead of taking this entry, it would have been waiting for price to break the structural high, so this structural high, and then get involved in the confirmation entry, which of course we did not get, so that would have saved us a loss, but no big deal even if we do take that loss. Price came down to this zone, although it did break structure to the upside. We're at the outskirts of the zone. We've actually broken the zone. So like I said, again, I'm waiting for a confirmation entry. So I wanted to see price break that structure, return back in, and then look for that long. We didn't get that. Price continued moving to the downside. And then we got our first entry here, which should actually be right here, not there, which was not tagged in until later on, but we did have this, which would in theory be our confirmation entry. But what I spoke about with the confirmation entry is if you have the risk entry like this that has enough imbalance, there is a chance that price is going to return back to that. So either be very careful on taking that confirmation entry in this event, or only take the risk entry, or just wait for another further break of structure and re-entry point, which our re-entry point would have been right here. This, in theory, is a very clean confirmation entry. We have a series of breaks of structure. We tapped into this risk entry and then broke structure. We've tapped into this risk entry. We broke some very minor structure here and then tapped into this point. But more specifically, we seeing a lot more momentum come into the market, which would be our confirmation entry, which we tapped into, which of course was also our 5-minute risk entry, and then price continued to the upside. And what we can see is there was an entry opportunity here, but this was during spread hour, so probably not the best time to be taking a trade. There was an entry here as well, and there are multiple entries that you can take, but the further we get in the range, the more difficult it is to really take a high probability, high R trade. You want to try and take it within the lower portion that has confluence with higher time frame points of interest. So of course, if we're looking at price coming to the upside, if price broke this swing high right here and started to come down instead, we could look at this as a point of interest, look for that. If we break that high again, or the newly created high, so say it came to this point here, break that, and then a point of interest was right here, we could look to buy with a lot more assurance. But once we start to see basically no man's land, it starts to deteriorate the fact we had this point of interest, which does look good, but price runs away from it. We never actually get there. So this would have been the only other real logical buying point that I would personally look at. This point, we're already in the premium pricing area of the trading range. So if I just draw on our premium versus discount tool, we can see that this is in premium pricing. I don't necessarily want to be buying in a premium zone, so I'll wait for price to pull back down. Where would it pull back down to? It would be this area. We didn't get that. We ended up hitting targets, but that's how I broke down the trade. That's the best way to approach it. I hope this video was helpful. I wanted to really put together all the things and create kind of one strong video to really kind of reaffirm how to best structure yourself on the charts.
I just want you to know that I also share trading signals to community for free in the Telegram channel. For example, yesterday, I share the gold signals to community. You see all 3TP getting profit yesterday, and the whole community getting profit by this trade. You can see every day I share trading signals to community, and most of them get profit. And especially, I do not only share the trading signals, but I also share the markup and the reason why I entered the trade. And by this one, everyone in the community can understand the reason, and by that, everybody can improve their trading skill. And to join community for free, you can click on the description of this video and click this link here, and you will be directed to the community and join for free.